SCHD is having a strong year, and suddenly people are paying attention again. But not long ago, many investors were asking what was wrong with it because it was trailing VOO. So did SCHD suddenly become a better investment? Or did recent performance simply change how people feel about it? Because two investors can look at the same result and want completely different things. One may care more about income. Another may care more about total growth. And whether you're 28 or 58 may completely change which result matters most. I'm using SCHD as a case study in why the same investment may fit one person, but not another. SCHD is a passive ETF that tracks the Dow Jones U.S. Dividend 100 Index, but it doesn't simply buy the stocks with the highest dividend yields. A company generally needs at least 10 consecutive years of dividend payments. The eligible companies are then evaluated using cash flow compared with total debt, return on equity, dividend yield, and 5-year dividend growth. So SCHD is attempting to combine dividend income with financial quality and dividend growth. And that can help reduce the risk of buying companies based only on a high yield. But it can't guarantee future earnings, dividend growth, or investment returns. The first question I'd ask after investing in dividends for 30 years isn't simply whether the dividend is growing. It's whether it's growing faster than inflation. And we examine SCHD's distributions over the 10 complete calendar years from 2016 through 2025. And after adjusting for the 3-for-1 share split in 2024, SCHD's annual distribution grew approximately 10.7% per year. Over the same period, inflation increased at a much slower rate. After accounting for inflation, the purchasing power of SCHD's annual distribution grew approximately 7.2%. So, over the full decade, SCHD's dividend growth substantially exceeded inflation. But it didn't happen every year. In 2023, inflation slightly exceeded SCHD's dividend growth. So even though the dividend increased, its purchasing power declined slightly. That's why I don't examine dividend growth without also looking at inflation. We then compared SCHD to VOO. Now, VOO tracks the S&P 500. It doesn't select companies based on dividend growth or dividend yield. We used the same 2016 through 2025 period to compare the two funds. We applied each fund's published calendar year total returns to a hypothetical $10,000 investment. The calculation assumes distributions were reinvested and it excludes taxes and trading costs for simplicity. The SCHD investment grew to approximately $29,800. The VOO investment grew to approximately $39,700. So, VOO produced approximately $9,900 more in ending value. Now, a different starting date or ending date would produce different results, but using a full 10-year period gives us a simple and consistent comparison. The income comparison looked different. SCHD consistently offered a higher dividend yield during this period and placed more emphasis on dividend income. So the two strategies produced different outcomes. VOO produced more ending wealth, SCHD provided more dividend income relative to the amount invested. It's also important to understand that dividends aren't free money. They're one part of an investment's total return. When one of the company that inside of a fund pays a dividend, cash moves out of the business and to its shareholders. It's part of a shareholder's return, not an additional return that's just created out of thin air. Another company may retain more of its earnings to expand, reduce debt, repurchase shares, or maybe make acquisitions. And whether that creates more value depends on how effectively management uses the money. And that helps explain how one fund can produce less dividend income while still at the same time create more total wealth. There was also a meaningful difference in how the two funds behaved during a difficult year. In 2022, SCHD's total return was approximately negative 3.2%. VOO's total return was approximately negative 18.2%. But that doesn't mean SCHD is safe, and 1 year doesn't prove that it'll always decline less or be less volatile than VOO. It means the investor experience was different during that particular downturn. For someone nearing retirement, the size of a decline may matter alongside that long-term return in income. So which result mattered more? Well, that depends on what the investor needed the money to do. At 28, you may be working, reinvesting everything, and trying to build the largest account possible over several decades. At 58, you may be approaching retirement and thinking more about replacing income and reducing the need to sell shares if a market decline happened. But age alone doesn't determine the answer. A 58-year-old with a strong pension, substantial cash reserves, may still prioritize growth. But age, time horizon, other income, and the job the money needs to perform can change which result matters most. The SCHD investor received a larger portion of the investment experience through dividend distributions. The VOO investor ended with approximately $9,900 more capital. And that capital could potentially be used to create income by selling shares. And some investors are perfectly fine with that approach. Others prefer to receive cash flow without having to sell shares. And that's a personal planning decision, not a universal answer. Taxes also matter. SCHD's higher distributions may create more annual taxable income inside of a brokerage account, even when those distributions are reinvested. VOO may leave more of its return in unrealized price appreciation, allowing more of that tax obligation to be deferred until the shares are sold. And the outcome can be different inside of a traditional retirement account or a Roth, and that's a big deal. Diversification also looks different between these two funds. On screen, I'm showing the top 10 holdings for each fund, but let me focus on the top 5. As of June 30th, 2026, VOO's top 5 companies were NVIDIA, Apple, Alphabet, parent company of Google, Microsoft, and Amazon. Together, these 5 made up approximately 28% of the fund. Its top 10 made up approximately 38%. As of July 24, 2026, SCHD's top 5 holdings were Abbott Lab, Merck, United Health, Amgen, and Home Depot. Together, those 5 made up approximately 22% of the fund. Its top 10 made up approximately 41%. So, VOO was more concentrated in its first 5 companies, but SCHD had a slightly larger percentage concentrated across its top 10. So neither investment is free of concentration. The concentration simply takes a different form. Then we have investor behavior. When SCHD was trailing VOO, some investors questioned its performance, its lower technology exposure, and whether dividend investing was still worthwhile. Now that SCHD has performed better recently, attention has returned to its yield, the quality screens, and different sector exposure. But the basic purpose of the fund didn't suddenly change. What changed was recent performance and investor sentiment. When SCHD was trailing, investors focused on its weaknesses. When it began performing better, they focused more on its strengths. That's how performance chasing can begin, and I've been guilty of it myself. An investor moves towards what's been recently performing well, and then market leadership changes, the new investment trails, and the investor moves again. I've watched that cycle for 30 years. Recent performance is not an investment objective. If your reason for owning SCHD was growing income, then a year when VOO outperforms it doesn't automatically mean the strategy failed. If your reason for owning VOO was broad market growth, then one strong year from SCHD doesn't automatically mean you need to change direction. The investment should be judged by the job you assign to it. This case study showed us that SCHD's dividend growth exceeded inflation over the full 10-year period. SCHD provided more dividend income relative to the amount invested. VOO produced more ending wealth. Neither result tells every investor what to do. Before choosing an investment, decide what result you're trying to create. Do you need income now? Or are you building wealth for later? Are you comfortable selling shares to create cash flow? What type of account will hold the investment? That's kind of big. What other assets and income sources do you already have? And can you stay with the strategy when something else is performing better? SCHD isn't automatically right because it had a strong year, and it wasn't automatically wrong when it trailed VOO. And remember, what fits you may not fit me. After investing for 30 years, I've learned that choosing between 2 good investments is usually less important than choosing one that fits your plan and staying with it through good markets and bad.